partners. Welcome to this session of DSP's Vision, sharing our investment journey with none other than Anish Tawakley, who has joined recently DSP as Chief Investment Officer. My first bit of the presentation is to introduce Anish, but not in the most traditional manner, but a bit differently for what he stands as an investor. We are familiar, as you can see on the screen, three types of images. Now, what is common between these three images and Anish as an investor? Temples which have stood centuries tell us the structure. These were constructed when modern technology or construction materials were not available, but still they stand the test of time. Chess is a game not about the best move, but not making the wrong move. And in cricket, the lovers of cricket, exponents of cricket say, declaring a match, the traditional test cricket, is what is more difficult than deciding bowling change or field placement. So we are talking about structure, we are talking about timing, and we are talking about judgment. Anish, as an investor, as a fund manager, combines all these very, very effectively. And we believe that is what creates investment leadership. Decades of experience, research at different entities like Barclays, Bernstein, and a fund manager with one of the largest fund house in the country, proven track record in managing different segments of the market, and happy to welcome Anish to DSP, his CIO, and his first interaction with a large segment of our partners. Over to you, Anish.
Thank you very much for the kind words, Usha. It's a pleasure to be here. I always feel that our partners play such an important role in doing the difficult job of handling clients for us. So it's always a pleasure to speak with them.
Sure. So, break the ice, and a small question. What's your investing journey very quickly? I mean, how did you become an investor, your research background, so that the audience gets to know Anish a little better?
I'll say that I'm still an analyst at heart, right? There's nothing more than that I enjoy than figuring something out, how an industry works, how an industry creates excitement, which is sometimes unjustified. And like my journey has been, I enjoy economics. That's my favorite subject. And this investing allows me to apply economic thinking to practical life situations. So that has been the reason why I've stuck on in this career for so long.
So now I'll touch on to it a bit later when I ask you about some of the funds that you manage. But let me get on to your investing philosophy. There's something very interesting you have shared in your few weeks here. I just want our audience to understand that rational and irrational part of the market philosophy, which you very beautifully capture.
So look, there are two main aspects to it. One is that markets are rational over the long term, but at the same time markets are not rational at every point in time. That's the reality. Second is that economies always go through cycles. We see those as periods of booms and slumps. In booms, demand is very strong, profitability is very good. In slumps, businesses are lying idle. These are two realities of the world. So the investment philosophy has to follow on from this. So when you think about it, it's obvious, right? That if the market is in an irrational zone, then you have to choose. You can either try to outperform, or you can remain rational. It is logically impossible to outperform while remaining rational if the market is irrational. It's logically impossible, right? And at that point in time, it's really important, in my view, to remain rational, not fall given to the FOMO that happens when everything's going up irrationally or going down irrationally. Second is that given that cycles are a reality, both top-down and bottom-up thinking are relevant, right? It doesn't make sense to say I'm only bottom-up. I don't care what's happening to the macro. It doesn't work, right? So you need to have, irrespective of whether even if your strength lies in bottom-up stock picking, you need to know the top-down context. Otherwise, you can do a lot of damage to your investors, right? So both top-down and bottom-up thinking is critical. The other aspects are like you need to have a disciplined process around asset allocation, right? And particularly if you're managing large sums of money, it's important to move in small increments, right? You need to be able to act contra. I feel that there are many ways to be smart in the market. You can be a growth investor, you can be a value investor, you can be a quality investor. But the one thing that I don't agree with is being a momentum investor. If you like something at 100, you should like it less at 200. Is the simple way to put it, right? So, and that is something like which will underlie all our funds here at DSP, that you can have different styles, but don't be momentum.
Sure. So, in other words, what you're saying, Anish, is don't get carried away in these euphoric times when it happens and try to outsmart, which is often what we see investors putting pressure on most of our advisors and, ending up making mistakes. And as a follow-on question on that, if you look at the markets, like you said, being irrational at certain points of time, 2024 September was the peak of the market. And from there to today, as my audience can see on the screen, most of the indices have not delivered great returns. While the narrative was something very different, the flows into small caps at that point of time was one of the highest, unprecedented flows we saw into the small cap segment. And you're someone who is quite vocal about your views on small cap, how to look at these kind of businesses, what are the risks involved, etc. So just want a little bit of time spent on that segment.
Look, so small cap saw a lot of flows in the last, say, 3.5 to 4 years. That's because primarily those flows are what we call reflexive, right? They were following performance. And that is the mistake that is the most common mistakes in the market. You get excited after something has delivered performance. And I've over the last year and a half, or in fact even over 2.5 years, I've been of the view that there is almost a bubble in small caps. See, if you look at the long-term history of small caps, right, you'll realize that the period of performance was actually very short, from 2020 to 24, effectively, right? If you were to take a longer-term view, from January 2008 to January 2020, that's a 12-year period, right, where it's like your child going through schooling entire from class 1 to class 12. So if you had put in money in January 2008 and waited till January 2020, you would have pre-COVID. Yes, that's important to note. It's pre-COVID. After that COVID hit, you would have made hardly any returns. Right?
I've put it up on the screen.
Yeah, so you would have hardly made any return over a 12-year period. And people forgot that. And then in that 20 to 23 or 24 period, they delivered spectacular returns. But then it is likely to be followed by a period of disappointment. See, if you enter after performance, right, the odds are against you. That's the simple way to put it.
Yeah. Correct. Anish, also interesting. Some of the debt funds delivered similar returns, better returns than the small cap in the 12-year period that you are talking about. Small cap also brings in a conversation on corporate governance. Would you like to share something on that?
So two aspects, right? One is how do you evaluate corporate governance, and two, what patterns do you see in terms of corporate governance? One is, for me, the best proof of corporate governance is the dividend payout.
Dividend
payout. If a company tells me the quality of earnings is genuine and the money is being returned to you, you get the cash, you can decide what you want to do with it, invest it back in the company, invest it in another company. Now, in terms of how do you evaluate corporate governance, right? There's no better proof than, no matter what the company is, profits are my share. Second, I'd say that, look, what patterns do you observe? You observe that corporate governance is cyclical, right? So at the top of the market, promoters want to raise money. So there will be a lot of good corporate governance initiatives, a lot of investor conferences, very extravagant guidance about what the beauty of how beautiful the outlook is for the next 3-4 years, and a lot of investor access. All questions will be answered. Then, after money has been raised, people will disappear, and there will be no investor access when the reality of the performance plays out. So So from an investor's perspective, right, it is very important at the top of the market to not fall for the stories, right? To not get carried away by the stories that are being told by the investors, by I get promoters in sorry, by promoters, the investment banking community, the private equity community. All of these you have to be very, very careful of. Yeah. So particularly for companies that don't have a history. If there's a history, in fact, I love companies that do very few meetings with the investors, right? Consistent, deliver profits in line with what you would expect in an industry. So if it's an cyclical industry, they underperform, like performance is not good in a down cycle, that's okay. That's part of the game, right? That's part of the business. But and they pay dividends consistently.
So a word of caution, couple of things on small cap: don't chase returns, don't come after the returns have gone, and then in bull markets or in euphoric times, be conscious of what narratives you are being fed.
Absolutely.
Anish, I'm going to move into the next one, which is a category which was not very popular as far as the market was concerned, came into being a couple of years back. You have built that category. There has been fantastic outcome for investors who have been part of yours, a tough category to manage because, like you said, your love for economics and the macro outlook plays very important role in managing a business cycle fund. But equally important is sector rotation, stock selection, so on and so forth. So I think it tests the knowledge, the understanding, the grip of micro and macro for fund manager. Want you to explain your method of managing this portfolio. What should an investor, advisor look at when he is buying a business cycle fund?
So this is a top-down sector selection fund, right? So first point, it will always have a segment of sectors. It's not a generic flexi cap. So at any point in time, there will be some segment of the market, with some meaningful segment of the market, which is whether it's sectors or industries, which we will have zero. So if you have to explain to your clients how it's different from a flexi cap, you can always show that, look, there's this segment of the market, which is zero in this fund at this point in time. That will change over points in time. Now, how will that change? That will change on the economic cycles. So what are economic cycles? As I alluded to earlier, economies go through periods of booms and slumps. We'll get to why those happen. But what is a boom? A boom is when demand in the economy is very strong. So businesses are working flat out, right? So if you're in your business, you'll find your capacity utilization is 100%. You're struggling to even find workers, or raw material supplies are a challenge because demand is so good. You say, hey, maybe I should even postpone this maintenance shutdown I should be taking, because it's so profitable to keep operating it, right? So if you were running a taxi service, should I send the car for servicing? Maybe not. That's what a boom is, right? And a slump is the opposite, right? Where if you're a factory which was operating at 3 shifts in a boom, you'd be struggling to fill 1 shift in a slump. And that happens because demand is weak. And the sectors that do well in a boom or a slump are obviously different. Now, it's also important to understand why these booms and slumps happen. Right? Booms happen when people are feeling confident, right? When there's generally confidence in the economy, and when people are feeling confident, they're willing to spend both for consumption and for investment. So you'll take the risk of buying a house because you're feeling good about your income stream in the future, right? So both spending on consumption and investment is high. And the obvious fact of the economy is one person's spending is another person's income, right? So when some people start increasing their spending, other people's income rise, and the confidence levels in the economy rise.
It's a fly.
So it's a virtuous cycle. The slump is the opposite, right? Slump is the opposite. What happens in a slump is people start feeling nervous. When people start feeling nervous, they reduce their spending. They want to save more. It's important to understand they want to save more. Now, but when you reduce your spending, one person's spending is another person's income. So when somebody cuts their spending, another person's income falls. And then it's a vicious cycle when people feel more nervous. Now, important point I made was they want to save more. But when incomes fall, there is less to save from. So actually savings fall. And this in economics is called the paradox of thrift. You try to save more, you end up saving less, right? Now, so these are the things that naturally would happen. Now, it's the policymaker's job to offset this, right? So if we are in a slump, monetary policy should cut rates to reduce the incentive to save. Remember, your savings have actually dropped because spending has dropped. But you should reduce the incentive to save to encourage people to spend more, right? Similarly, in on the government side, they should cut taxes to encourage people to spend more, right? The government should be willing to borrow at that time, right? And or very low, and government should spend more. But very often the thinking is contrary to this, right? Now this is logical but counterintuitive, right? It's logical that when the private sector is not spending, the government should spend. It's logical, but it's counterintuitive, because what happens is when the economy weakens, tax revenues drop. So the fiscal deficit, even if the government has not increased spending, looks larger. And all the deficit hawks, they will start worrying about, wrongly at the wrong point in time, start saying, no, this is bad. Government's fiscal deficit has increased. Why is it spending? But actually, if the government is spending, it's doing the right thing. You should actually increase the spending at that time. So the point is that policymakers' job is to work counter-cyclically to offset the cycle. If the private sector is not spending, is nervous and not spending, government should spend. Should reduce rates to try to increase spending. And if they do the right job, then the cycles are more moderate, right? The booms are less. At the top of the cycle, the government's job is to curtail spending. Or similarly, the RBI's job is to curtail investment activity. So the point is, these will always happen. And the interesting thing is, I don't have to take a 10-year view whether India will grow at 8% or 10%. I just have to say, look, will this economy, is it in a slump or in a boom? And is policy action such that it will lead to curtailing the boom and curtailing the slump, right? So will we move back towards normal? That's an easier call to take. I don't have to take a 10-year view. And the sectors that do well in a boom versus the sectors that do well in a slump are different, right? If you are in a slump and you feel, look, government and the RBI are committed to reviving the economy, then don't be in doubt about, will a 25 basis point rate cut be enough? RBI will do more if required. You just have to have the confidence that slumps don't last forever. The RBI or the government have decided to fix this slump, it will recover. So you play on cyclicals, right? So cyclicals are stocks like auto, which will be beaten down at that point. Banks, right? Cement, capital goods. And then you're basically saying, look, the earnings have been downgraded as much as they can be downgraded. From here, earnings upgrade cycle will start. And that's how you pick sectors.
So in a sense, either of the situation of the economy, we have sectors to play and stocks to buy. And the best way to rotate them and identifying the economic cycle is the way the fund is managed.
Exactly.
Right?
Yeah.
Okay. Anything else?
So the advantage is for an investor, from an investor's point of view, right? Very often investors like to invest in sector funds.
Yes.
But what happens is they come in right at the top when the sector has already done well.
Yes.
Or even if they've come at the right time, they don't exit, right? So here, like, if you think we understand macro, and if you, like, many times even partners ask, what sector do you like now? Yes. So I say, if you're going by my recommendation, then might as well take the business cycle fund and then stick with me throughout, right? If you trust my recommendation.
Multi-sector.
It's a sector rotation.
Right. Sector rotation. Yeah. Fair enough, Anish. Thanks for a very detailed answer on that. I want to ask another question to you, which is again a category that you have managed. It's not a very exciting category for a lot of investors and partners. They say that index is good enough. It's a large cap category, but the blue chip companies form part of that index. And very often I've heard you say that today the value is largely in the large cap space. Again, a category that you have a fantastic track record. You have taken over at DSP to manage that portfolio. The stocks have not done too well in the last couple of months or quarters. What is your take on that? How should one look at a large cap as a fund? What is its power to generate alpha for an investor?
So a few points, right? Because there are two or three aspects that need to be addressed there. One is, can a large cap, actively managed large cap fund create alpha over the large cap index?
Yes.
Then the second is the comparison between large cap and small cap, right? So look, there's 10 years back, this was a very big debate whether large cap funds can create alpha or not. But now if you look over the last 10 years, quite a few of the large cap funds have created alpha. So the evidence is with us. Second, like, I know passives are a very hot topic, but let me put a simple proposition to you. If you like something at 100, should you like it more or should you like it less when it's become 200?
Less.
Less. What does the passive fund do? It invests more at 200 because it's become a larger part of the index. So conceptually, I'm not saying I will beat that passive index, but somebody who follows the discipline of trimming, reducing weight should be able to beat. Theoretically, I don't think it's impossible, right? It doesn't require a genius to say, look, if you like something at 100, you should like it less at 200. So I do think, like, even conceptually, one should be able to think about active investing. My own philosophy as far as large caps is concerned, look, I appreciate that large caps will have not that many multi-baggers, right? So you're not looking for searching for multi-baggers, but you create alpha by avoiding the difference between the 20th and 25th is not that much. Maybe the difference between the 10th best and the 20th best stock is not that much, but between the 20th and the 80th stock, there's a big difference. So if you put a lot of effort into risk management in trying to understand where are the pitfalls and avoid the stocks that end up in the bottom 30%, right? The entire effort is focused on, let's not worry about whether this is the best or the 10th best, but is it likely to be in the bottom 1/3? If you avoid the bottom 1/3, you do well, right? I mean, the second point I like, and this again is my personal, other people may have a different approach. Like, I have observed that if you are consistently second quartile, which means you don't fall into third or fourth quartile, but on a 1 year basis, right? So if you're every year you are second quartile, then on a 5-year basis you end up in the top quartile.
Interesting.
Right? And don't confuse this for mediocrity. You're not right. It is consistency and mediocrity are different things. To be second quartile, you have to be very disciplined about risk every year, and over a 5-year period, you'll end up near the top. You had started with sports analogies, right? I always say, look, for me, this is like, and a lot of people follow cricket. This is like fielding in the slips. You don't have to do anything, but you have to be ready to act if there, right? So, like, if you hear a good coach on fielding in the slips, he'll tell you have to only be looking at the outside edge of the bat. That's it. You're not looking at the bowler. You're not looking at what anybody else is doing. Not listening to the crowd. You're only looking at the outside edge of the bat, and you act when an opportunity arises.
Anish, you're mentioning about avoiding the bottom 30%. In a segment which has 100 stocks, which is very well researched, you still find there are pitfalls, or you think there are pitfalls to avoid.
Yes. Yeah.
That is a very interesting point for our viewers, that being consistent in Q2, because the typical tendency is to look for the best performer of the last year. But here is a very different dimension.
Yeah, in 3 years you'll be fine.
Yeah, fine.
Yeah.
So be quartile 2
consistently
yeah, on a yearly basis, and then you see how it plays out over a longer period.
I mean, that has worked for me. I'm not saying other styles are not valid, but that has worked for me.
Yeah. So let me move on to another question, which is obviously bothering a lot of our partners today. We see that FIIs have been pulling out left, right, and center, and a huge interest of Indian investors to go global. Suddenly, there is a lot of interest into investing in global funds. GIFT City is opened up. There are choices available. How do you look at both these dimensions, Anish?
So firstly, like, let's look at the FII question. See, I have a very simple philosophy. There are things that you try to predict, and there are things that you try to react. not try to, you react.
Yes.
Reaction you can do, right? There's no try to, you can react.
It automatically
Yeah,
happens.
right. So there's things that you try to predict, things you try to react, that you react to. Flows I react to, I don't try to predict flows, right? Flows are based on moods. It's very good topic to discuss over dinner, but really there is no quantitative, there's no real good model for predicting flows. I have not come across any. And anyway, if you're buying based on flows, that there will be flows, you're buying on the greater fool theory, which is not a good way to invest. And the third thing I find is that even if there are flows, which means inflows, supply also gets created. And that's what you saw in small cap. Ultimately, what capped the small cap returns, there were still flows, inflows. But so many promoters and PE came out and supplied enough that it capped the returns, right? So the flows did not generate returns beyond the point, because supply also gets created, equally gets created, right? So I say, look, I'm not going to get into this business of predicting flows. I'm going to focus on the economic outlook. If the earnings are there over time, see, because flows can only influence multiples. Flows do not influence earnings, right?
PE gets influenced.
PE gets influenced, right? The point is now whether, if anyway, I say you should invest at least for 3 years. You should do the math. I'm not going to give a number because I'm not allowed to. But say if grow at X% for 3 years, earnings grow at X% for 3 years. Even if the multiple comes down from 21 to 19, if that earnings growth is a good number, you'll not be badly off, right? So there's no point discussing flows actually. As far as Indians investing overseas, look, I mean, I always recommend some diversification. And at this stage, I'm not saying overseas markets are more attractive than in the Indian market, but I think from a diversification perspective, if you don't have any exposure, it makes sense to have some exposure.
Interesting segment or a category which got a lot of flows last year was the multi-asset category, the ever popular dynamic asset allocation category, hybrid range, Anish. Suddenly they have started getting far more traction. And the multi-asset category did get a lot of interest because they have an exposure to commodities. Commodity did very well. And some of the funds like us do have a global exposure as well, which also contributed to the returns. At this juncture, considering the economic environment, the valuation, the overall, global and the domestic environment, how would you place hybrids for an investor, and what should our partners be doing?
So asset allocation, as opposed to just like a standard hybrid, right?
Yes.
I think asset allocation products are very good products for the investor. And see, the good thing about asset allocation is, particularly, they should be run with an objective, dispassionate model, right? When the valuations are attractive, it should invest more. And the other thing which people miss, right? They only think about the extremes. See, if you're running a model consistently with for an asset allocation product, even in a flat markets, right? If you're doing the +1 -1 you'll generate some returns, right? If the market has been flat for 2 years, it would have moved up and down. If you were disciplined about asset allocation, increasing the allocation when the market dipped, and decreasing it when it was down, you create some returns. And obviously you create the mega returns if there's a big crash and you deploy at that. The difference between DAF and MAF, see, look, it depends on whether you're taking gold exposure outside or not, right? If you're anyway buying gold separately also, then the DAF might be better for you, better suited for you.
Sure.
Right. So that depends on how people handle gold.
Gold, or the commodity exposure, which is getting
gold and
played.
Yeah.
To our viewers at DSP, we do have an entire bouquet of hybrid choices: the aggressive hybrid, the DAF, the MAP, the equity savings, etc., which all is run pretty well on different models, and different strategies are playing out in that. So that is something that all of you can look at it. Cash always becomes a topic of discussion, especially when times get tough or times get too exciting. How do you look at cash as a part of the portfolio management strategy?
So look, the way I think about it is, each fund manager needs to have a clear strategy which he follows then over time. at the top of the market, you cannot come and say, I want to be zero cash, and at the bottom of the market. So you need to have an approach that you are consistent. So the most important thing in as far as cash is concerned, you need to have a consistent philosophy. Either you say cash is part of the investment approach, or you say it's not. And then there should be some quantitative thinking, just like asset allocation between cash versus not cash. At least there should be something guiding it in the background. See, my own approach is that I work with a risk budget, right? So if I'm managing a large cap fund and I'm saying, look, I'll be 40% active weight, then cash is an option in that active weight, right? So I'll say, look, if I've already taken my 40% active weight, I've taken the positive positions where I like the stocks.
Yes.
And if there are some stocks that I think will really do nothing, I'll keep some cash, right? If I feel that these can be negative return, I won't invest for the sake of it. And I won't add more to the ones that I like because my active weight has the risk budget is done with, right? So in that sense, like cash becomes an outcome of the overall active weight budget, right? Because I'm not going to say, oh, I really like this, I'm going to become a 60% active weight fund, because that's not the
cash is therefore an what about a fund like a business cycle fund, Anish? How would you look at cash?
I mean, same, right? Like you can have some cash, right? If you think, look, economic outlook is good, but valuations are not that cheap, so you might get some dips. You can keep that for the.
So cash is more an outcome of your investment allocation in your activities, and then what you want to do with that.
Exactly.
Fair. Question on SIP versus lump sum. We are, every day printing numbers of our SIP collections. Of course, we referred to it in the small cap space. A large part of that SIPs have come in the small cap space. But when you look at the table here, the lump sum returns and the SIP returns, even in the last period, which was the peak of 2024 to now, SIPs seem to be reasonably better off than doing a lump sum. And this question keeps coming. Should we do an SIP or a lump sum? Views on that in your...
It depends a little bit on what is the nature of your flows, at which stage of your life cycle are you. If you're a young guy with stable income, which is, salaried income, which you think will come at least for the next 20 years, then your inflows are monthly. So you might as well allocate it through a SIP, right? There's no point trying to, and you're not in the business of every day looking at the markets all the time.
Sure.
So then it's better to say, look, I anyway don't need the money for 10 years. I'll put it in some equity fund, etc. Right? The challenge is if you have lump sum money and then you have to choose between SIP and that. And the thing that here you've said, look, SIP still outperforms lump sum because we've been only in a flat market.
That is right. This is about to refer.
Right. See, the problem happens if you deploy. So the real, if you have a lump sum of money, the real question to ask is, will you chicken out if markets correct, right? That is the worst thing you can do if you do a SIP. So you have to be disciplined then about. Ultimately, answer comes down to discipline only, right? Because what would be terrible is if you average up, keep investing on the way up, and the market corrects, and then you back off. Because then you've averaged up.
Sure, that is right.
That is
so. Yeah. Most of our viewers, while this data talks about 2024 peak to now, like you very rightly pointed out, you have got a flat, at points in time in the last 18 to 20 months, dips also. Your averages would have looked better, which is what is probably a bit of misleading information. But
in general, if you're if you have a stable inflow which is periodic, it makes sense not to accumulate
and deploy.
Then you upload things systematically.
So SIP still remains to be seen through the rupee cost average.
But don't chicken out when there's a correction.
Yeah. So Anish,
that's where I think the partners play a very critical role.
So to all our partners who have been encouraging SIPs and the book that has got built over a period of time, fairly stable inflows that we are still seeing. And seizures are there, but like you said, it's a normal percentage. But yes, continue the SIP for the longest period is extremely important. Thank you very much, Anish.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.